The stock sell-off on Wall Street has intensified in the days since the Federal Reserve signaled interest rates getting higher and staying high longer. Fed Chairman Jerome Powell delivered a knockout punch to stocks last week in an 8-minute speech from Jackson Hole, Wyoming. The recent sell-off comes on the heels of a pretty spectacular recovery in stocks during the month of August. But that seems to have made Powell even more determined to quell optimism as a part of fighting inflation. This video continues our coverage of these extraordinary events. What does this mean for stocks? What does it mean for inflation? What does it mean for the job market? What does it mean for the US economy? And what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Stocks fell for a third day, virtually erasing a summer rally. The Federal Reserve and central banks around the world moved to defeat inflation no matter what. This is despite a strong job market, healthy corporate profits, and a generally strong economy. The S&P 500 fell 1.5%, taking it below the 4,000 level. The Nasdaq Composite fell 1.8%. The Dow Jones Industrial Average fell 407 points, or 1.3%. The S&P 500 was down more than 3% on Friday following the inflation-focused comments from Fed Chief Jerome Powell. The market rout has continued into this week. The remarkable comeback of the stock market from its mid-June low has now been reduced to 9%. We want inflation reduced to our 2% long-term target, and we are still far from that goal, said New York Fed President John Williams. Williams' remarks reflect those of European Central Bank policymaker and Governor Mattis Muller. Muller basically told the world to expect a 75 basis point hike in interest rates following the Federal Reserve meeting in September. The mild inflation report in July obviously led traders to think that interest rate hikes would be modest and then rates would start to fall in 2023. Powell has said, in no uncertain terms, that isn't going to happen. Wall Street is now reacting to the new normal and interest rate realities. The 2-year Treasury yield exceeded its highest level in 2 years. The markets are fragile, and the hawkish message from the Fed suggests that lower interest rates are not in the cards anytime soon, said Stephanie Lang, CFO of Homrich Berg. The Fed is focusing on inflation as their primary priority, continued Lang. That narrative puts a lot of stress on the market, Lang continued. We need to get ready for a lot of volatility going into year-end, said Lang in her statement. Depending on the Friday jobs report, the Fed could decide to take a more measured pace with interest rate increases. But a strong jobs report could just bring more of the same rhetoric from the Fed. We're at a tricky juncture, but I don't think any particular data point is going to give relief to the market, Lang said. We are going to need to see several months of actual inflation data continue to move down for the Fed to feel any bit of comfort, Lang continued. Meanwhile, New York Fed President John Williams told Wall Street not to expect any reductions in interest rates in 2023. Williams expects interest rates to move higher and stay higher for longer until inflation is under control. Williams did not give an exact target or maximum expected interest rate. But he said that reducing inflation will mean that real interest rates need to stay positive. But, what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.